We've got Madan Sabnavis, who's Chief Economist at Care Ratings, joining us on the show. Madan, to begin with, the 5.3% number that we saw come out last week for the fourth quarter, and the fact that the annual number was reworked to something like 6.5 against an earlier expectation of 6.9. Does that in some sense, or would you say that that is indicative of what things could look like in the coming quarters, given the fact that the global environment isn't looking any better?
No, in fact, I would tend to think that things are slightly going to be better because things have sort of bottomed out last year. Because if you look at the overall economic conditions which existed last year, I don't think they can deteriorate any further. And on the
why do you believe it won't deteriorate?
So, for example, if you look at the kind of policy responses, I think on the monetary side, things have to be only positive going ahead. It's of course a whole question of timing, whether interest rates are going to be reduced now or whether it's going to happen in the second half. I should tend to think it will be more in the second half rather than in the current period. Similarly, if you're looking in terms of fiscal policy, I think all the kind of apprehensions which we had about the budget, they very much continue to exist. But I think the government seems to be more concerned about trying to speed up growth and the kind of announcement effects which we're getting from the government in terms of expediting projects which have been in limbo all this time. I think it's very good, makes a lot of positive sense for the economy. So I don't think things are going to get worse from here. There could be a marginal improvement probably, but things will only be positive rather than negative.
So you're saying things won't get any worse on the domestic front?
Right.
Right. But on the international front, if everyone's talking about the likelihood of a Greek exit or a Grexit or possibly even a Spexit as they're calling it, then what happens? Because then, you've got the impact of all of that playing on us, and then, our market somewhere getting impacted because of that.
Yeah, we're going to get affected more on account of the sentiment, because if you see how is the euro crisis going to affect the Indian economy, it would be in terms of trade, it would be in terms of investment flows, and above all sentiment. And in fact, if we're looking at trade, if you see our exports, I think there's been some kind of diversification in our exports away from the developed countries to the emerging markets. So I think that's going to provide quite a bit of buffer going ahead for us on exports. In terms of investment flows, yes, I think that's more, it's going to be a combination of what's happening in the euro region, as well as what we have created for ourselves. I think the GAR, retrospective taxation, has affected investment flows, and I think that's going to continue to remain for some period of time. But I think on the positive side, what we have seen is that foreign direct investment has been very robust last year. We've had something like $35–36 billion coming in, which means that if you're talking of foreign investors who are looking at direct investment as an option, they definitely do believe in a long-term growth story of India. Probably today it's a bit muted, but things would be looking better maybe in another 3–4 years' time. So all this gives me reason to believe that things are not going to deteriorate any further, notwithstanding the fact that we would be having probably a euro crisis sort of getting exacerbated as we go ahead.
Amid all of those pessimistic views, that's a fairly positive voice. But Madan, given the fact that the GDP numbers have been lower than expected, crude prices have been following, what kind of action are you expecting from the RBI? Do you believe that the inflation could perhaps limit, the room to maneuver rates?
Yeah, absolutely. In fact, I think all of us like to give advice to the RBI as to what they should be doing. And I'm quite aware that even they know that they should either be reducing interest rates or not. But going by what the RBI governor said in the last policy, that don't expect any further rate cuts, and the fact that inflation, which has been the motivating factor for monetary policy for the last 2 years, still remains in a fairly uncomfortable territory of around 7%. I should think that there's no economic reason or rationale for lowering rates. But however, this said, I think given the fact that sentiment on the whole seems to be very perverse today, like everybody is unhappy about the growth numbers, about the IIP numbers, about the core sector growth numbers, about the depreciating rupee. I think one way, and I think there's some statement made by the Deputy Governor yesterday also saying that there is some room for cutting interest rates. So there could probably be some kind of sentiment-based pressure to lower interest rates, but definitely I don't think there's any economic basis for lowering interest rates as of now.
Right, and Madan, would you say that the one big point of concern for everybody ought to be the fact that investment is not taking off? Even if in the fourth quarter we did see some marginal uptick, the fact that we were in negative in the previous 2 quarters, and the fact that when things look better, the capacity constraints is going to feed inflation. Do you believe that's actually going to be the big worry for us going forward?
Yeah, definitely. That's a worry, because we're talking of high interest rates impacting growth. It's more on the investment front, because if we are talking of capacities not being created in the last couple of years on account of high interest rates, and that's something in a rating agency we've also viewed the same thing, that if you see the number of proposals which have come up have been muted on account of people basically not borrowing money for investment purposes, which they're not quite sure where the economy is going, where interest rates are headed. So I think that's going to be a major stumbling block for us going ahead, because as and when the economy does revive, there will be demand coming in. And the whole question is that are our sectors really prepared for meeting this kind of demand? So that would definitely be a concern. I'm quite sure that the whole entire process of recovery is going to be fairly gradual. So we will not be reaching the situation where there will be a major gap between demand and supply, which will create inflationary pressures.